So what is project finance and how does it differ from other forms of finance? Put formally, project finance is simply the creation of a legally independent project company. Sometimes you'll hear people referring to this independent company as a special purpose vehicle or an SPV. Now, the mandate of that SPV is to invest in a specific capital asset or specific project. And the project is explicitly stated, and its scope and what the project is going to be doing is clearly laid out and documented. Now, funding for the project comes from two main sources. The first source is the sponsors or owners of the SPV, and they will inject capital into the SPV in the form of equity. In addition to that, the SPV will also source capital from banks and other financial institutions, and they will invest debt capital. So there's equity and debt provided by the banks and other financial institutions. Now, the debt is issued to the SPV on a non-recourse or limited recourse basis. What does that mean? It means that if the project collapses, if it fails, the providers of the debt, the banks, they can't go to the owners of the project, the sponsors, to compensate them for the losses they have incurred by lending money to a failed project. The banks are limited in their claims for any loan they may make for the project to the SPV or to the independent company that houses the project. So if you look at a typical project finance transaction, it will be characterized by the following aspects. One, there's a clear special purpose vehicle which houses the project. Two, the nature of the lending is that it is cash flow based lending. So the banks will focus on the cash flows the project can generate to see whether their interest and their capital will be successfully paid back. Their focus will always be on the project's cash flows. They won't look as much at the collateral or the underlying project assets. They need to get their comfort from the project's cash flows. And the cash flows will determine how much the banks are willing to lend to the SPV and also the terms of those loans. The lending is non-recourse, or more accurately put, limited recourse. The banks are limited in their ability to claim any losses on the loans advanced from the sponsors. And fourthly, there are extensive and explicit risk-sharing structures. So if you look at project finance arrangements, they attempt to distribute or to disseminate the risk related to the project amongst the multiple parties involved in the project. And they try and give this responsibility for each risk to the party that can best manage, best control, best mitigate that risk. Also, project finance enables what we call off-balance sheet financing. So for each sponsor, there'll usually be multiple sponsors. For each sponsor, they do not have to reflect the full project on their own balance sheet. Each sponsor will not be required to consolidate the project onto their group financial statements. They might account for the project as an associate, an investment, a joint venture, but it won't be on their balance sheet. So these are really key characteristics of project finance. You've got a special purpose vehicle, you've got cash flow based lending, you've got non-recourse or limited recourse lending, there's extensive and explicit risk sharing, and it enables off-balance sheet financing. Let's go through each of these in more detail.